Okay, I think we'll get going. There might be a few other people that join us shortly. So you're here for the webinar tonight on everything you need to know about moving your UK pensions to Australia and putting them in a superannuation scheme or possibly pulling them out as cash. I'm Stephen Ford. I'm the head of UK financial planning. I'm going to be the MC and chief button pusher tonight. But our two presenters for the evening are going to be Paul Davies, who's head of international advice and has worked in the industry. Actually, it was just the other day he realised he'd worked in the financial services industry for 30 years. So extensive experience and one of the owners of BDH Sterling as well. And we also have Paul Lawson-Tyers, again, another 10-year veteran of transferring pensions, mainly to Australia. So those two will be giving you the content for this evening. And then as we move through, it'll probably take about half an hour for the content presentation. And then there'll be a Q&A section at the end. For the Q&A, there's a Q&A button. There should be a ribbon amongst your menus. If you could put your questions in there as you go along and think of them, that'd be fantastic. That'll leave Paul and Paul the chance to read them as they go and start to prepare the answers so that we can move through it smoothly and succinctly. If you get a bit lost, then there's a chat function as well. Perhaps you can pop your questions in there if you want to add it there if you can't find the Q&A button. If we could leave you or have you not ask the questions verbally and keep your system on mute, just so that if you are double tasking, there's no background noise affecting the presenters and the other guests. That's about the only other condition. I'm going to hand over now to one of the Pauls who'll get started.
Okay, thanks Stephen. So to start off with, I'm going to go through today's agenda, so you know, so just to make sure you're in the right seminar. So first of all, we're going to go through types of pensions and why transfer. Second, we're going to run through cure-ups. Then we're going to run through the transfer process. We'll tell you a little bit about BDH Sterling. And finally, as Steve has already said, there's going to be a question and answer session. So to talk through the types of pension, first of all, I'm going to hand over to Paul Lawson-Tyers.
Yeah, hi everyone. So yeah, first of all, I'll just take you through the different types of pension in the UK and what you can and can't do with them. So there's essentially 5 main sort of areas of pension in the UK. There's company schemes that are invested, and so you've got a fund value and they will move around with the investment markets. There's personal pensions. There's defined benefit schemes, as they're called. So you'll usually know them as something like a final salary scheme or a career average scheme. There's the UK state pension, and then there's annuities that you might have bought with your pension fund that then pay you a pension for the rest of your life. So just taking you through the ones that can and can't be transferred when you're looking at moving to Australia. So first of all, those company pensions that are invested, they can be moved, as can personal pensions that are also invested. Then you can move defined benefit schemes. I'll take you through what the difference is between defined benefit and defined contribution, as it's called, in a minute. But most of those defined benefit schemes can be moved as well, as long as you haven't already started drawing on them. Looking at what can't be transferred, well, the UK state pension can't. That would still pay to you from the UK government, although it may be possible under reciprocal agreements to get the Australian government to pay that to you. And then there's government unfunded defined benefit schemes that can't be transferred. So there's some specific ones here. We're talking about the NHS, police, armed forces, teachers, civil service, and the firefighters scheme. So you're noticing amongst those that I haven't mentioned the local government pension scheme. That is classed as a funded public sector scheme. So essentially, what under the banner of local government, you'd be in something like, I don't know, the Greater Manchester Pension Fund or the West Midlands Pension Fund, and they run their own scheme in effect. So it's a bit different to something like the NHS. You can still potentially transfer those. Whether it's in your interest or not is a different matter, and Paul will take you through a few considerations later. If you've got a company pension scheme that's entered the pension protection fund, you won't be able to move that either, and you'd know if you've got a pension in the pension protection fund. If you've already started drawing on your pension, if it's a defined benefit type scheme, then you can't move that. That would still pay to you from the scheme in the UK. And if you've purchased an annuity and that's started paying to you, again, you can't move that. So moving on to the next slide, we'll talk about the difference between defined contribution and defined benefit. I've obviously mentioned defined benefit a couple of times as a term that we use. So defined contribution schemes are your personal pensions and those company schemes that you've got that are invested and move around with the investment markets. So they are defined by the contribution that you've paid in and the investment growth that you might get on that over the years. As to what sort of fund you have at retirement to then provide you with income, either by purchasing guaranteed income with an annuity or by remaining invested throughout your retirement and drawing from that fund. With a defined benefit scheme, like a final salary scheme, you have a defined benefit, a defined annual income. It doesn't have a fund value that fluctuates with the investment markets. You have a guaranteed income in there. And that is based on your, well, either your salary at retirement, if it's final salary, or you might have a career average scheme or some sort of hybrid where it takes an average over a number of years of your salary. And then it's the number of years that you've been in the scheme, and that will determine how much you've got as an annual pension in that scheme. So that's the main difference. You've either got a fund value or you've got an income, a defined income from that scheme. So that's just basically how different pensions work in the UK and what you can and can't do with them in terms of transferring. Now, Paul will take you through all the various considerations as far as whether you should be looking at transferring your pension.
Thank you, Paul. So, Paul's kindly gone through the different types of pensions. So given them and the benefits, why would you consider transferring? So one of the key reasons that we look at is currency control. So obviously the UK and Australia have a different currency, and that has fluctuated quite a lot over the years. So given an extreme example, back in 2008, you would be getting 272 Aussie dollars to the pound. 2013, you'd be getting around about 145 to the pound. That's a big difference. And so to put that into some sort of context, if you, for example, were drawing income from a UK pension, you were living in Australia, you were drawing £10,000 a year. In 2008, you could be getting as much as like $27,000 a year from that pension with the exchange rate as it was. Fast forward to 2013, you've got exactly the same income coming from the UK, £10,000, but it's only getting you $14,000 or $14,000 to $15,000. So it's almost like half what you would get just because of the exchange rate fluctuation. So that's a key consideration. When you're moving back to Australia, your lifestyle is going to be in Aussie dollars, but your income, if you're drawing it from a UK pension, will be in pounds. And as I say, given the fluctuations over the years, that could make an extreme difference. Next slide, please, Steve. So what are some of the other considerations to transfer? So yeah, Paul's touched on defined benefit schemes. So they're very good schemes, they've got very good guarantees, but sometimes the death benefits in those sort of schemes aren't particularly appealing, certainly to people who've got like spouse and family, or maybe even a young family. So the death benefits are quite restricted. So if a member of a defined benefit scheme passes away, then the benefits to the deceased spouse can be quite limited. So, for example, it could be 50% of the income that the member would have otherwise got had they have survived. Another consideration as well with defined benefit schemes are they are quite expensive schemes for an employer to run. There's a big liability for a company. Now, you might have seen, like in the news, the BHS, British Home Source Pension, was one big story, and how the funding levels on that were. So employers at times cannot afford to keep these running. If they can, very good scheme, but there is that consideration, and it's always good to get an up-to-date statement to see the funding levels of the scheme, and is there any danger of it moving into a pension protection fund. Other considerations: investment control. In your current pension scheme, so this would be more suited to someone with a defined contribution type scheme, you might not be happy with the investment returns. Another consideration would be if you are moving to Australia, you might have more favourable, or you certainly would have more favourable tax treatment if you moved your funds across to Australia. Typically in retirement in Australia, retirement age 60, the funds you will receive from your superannuation would be tax-free from retirement age 60, whereas pension benefits being paid across from UK to a resident in Australia would be assessable for tax as foreign source income. And another thought would also be just to consolidate your pensions, even in the UK, possibly before you go, to potentially increase your returns and maybe cut down on various different charges across several plans. So things to think about before you transfer. So one of the things that we would certainly maybe encourage you to do, if you have that, if you have the scope and if you have the expendable income in the UK, is to maybe contribute to a UK pension scheme if you're not doing it already, or maximise the contributions that you're already making. The reason being, it's a very tax efficient way of saving, so you get tax relief there on the way in, and tax-free growth as it accumulates. And as I said before, ultimately, if you're going to transfer it across to Australia, you're going to get tax-free benefits at the end. Next slide, please. Why transferring your UK pension may not be best for you. So it's not absolutely for everyone, and this is where the importance of the advice that BDH Sterling can provide you comes in. There's a few examples there on the screen. Might not always be cost effective. There might be good performance in your current scheme. There could be penalties for leaving the scheme at an early date, and also a defined benefit scheme is seen as a valuable scheme. So a lot of the investment risk and cost is borne by your employer, so that you might not be in such a rush to move out of that. As I say, again, it's a very important advice piece that needs to be covered. One of the key points when it comes to considering a transfer to Australia is that, as the way the current legislation stands, you can't actually transfer your pension fund until you attain the age of 55, which then brings into the question what you should be what you should be doing with your fund in that interim period. So first of all, what are your options? So you can transfer or consolidate into a UK self-invested personal pension, which I'll go on to in the next slide, or private pension, or you may wish to leave your pension scheme in its current form. So what is a SIPP? So a SIPP essentially is a personal pension scheme which allows individuals to make their own investments decisions. There will be limits. There's certain things you can't put into a UK pension scheme, for example, like a residential property or antiques or cars or anything like that. But with the approval of HMRC, there are quite a range of investments that you can put in. In that respect, if you're familiar with a self-managed super fund in Australia, it is very similar to that. One of the benefits of a self-invested personal pension is that it can be invested in pound sterling, or it can be invested in Aussie dollars, the pension fund that's held within there. So that's quite important, particularly for people who move back to Australia. They may be there for a long period before they attain the age of 55 and able to transfer across. It allows people to align their pension funds into the same currency as what their lifestyle is when they move to Australia, and obviously throughout retirement at the earliest possible opportunity. Other considerations would also be that the death benefits can be slightly more favourable if you're looking to attain a lump sum death benefit than it would be from a defined benefit pension scheme. So that might be one consideration to move across, but it is very important to get advice on that first. If you have reached the age of 55, then you do have an additional option, and that would be to transfer over from the UK to Australia. Now, when you transfer across from the UK to Australia, there are a couple of things to consider. The first is the scheme that you're transferring across to has to have a status which is known as Qualified and Recognised Overseas Pension Scheme status. Paul's going to cover that later in the slides. And Australia have a limit on how much you can transfer in each Australian tax year. So advice needs to be taken on how you can kind of split your funds up if you have the large funds and moving it across within the Australian permitted limits. And of course, you have the option of just leaving everything where it is and ultimately waiting until retirement age and drawing your funds from a UK pension scheme. Again, going back to what we said before, there might be sort of tax implications from doing that. But again, that's something we can talk you through. As I mentioned in the previous slides, CUROPS, so I'm going to hand back over to Paul Lawson-Tyers, who's going to talk through that.
Thank you, Paul. So in terms of CUROPS, Qualifying Recognised Overseas Pension Schemes, as Paul was just mentioning, this is a regime from HMRC in the UK that allows transfers to be made easily to overseas schemes. It was only actually introduced in April 2006. Before then you could make transfers, but it was quite tricky. This was designed to help people to be able to move their pensions abroad. Some people think CUROPS are a product. They're not. They're a pension scheme registered in the country that they're registered in, that have applied to HMRC in the UK to accept funds from a UK pension. And they then are granted this Qualifying Recognised Overseas Pension Scheme status. And in return, they agree to adhere to certain rules that HMRC lay down in terms of what you are allowed to do with the benefits, and they have to report back to HMRC on benefits that are being taken. Now, that used to be quite constrictive in terms of the UK had limits on how much you could take out of a pension scheme each year, which made it quite tricky if you were drawing from an Australian scheme with that fluctuating exchange rate that Paul was talking about earlier, and ensuring that you didn't go over the limit that HMRC would allow you to take. So it was still quite tricky from that point of view, but it did give you the opportunity to move the funds to your country of residence and denominated in Australian dollars as a result. So just moving on to the next slide. Since 2006, there have been some changes to QROPS. Now, I mentioned that it was quite constrictive before. Well, in April 2015, HMRC, the government, brought in new rules in this country in terms of pensions and the amounts that you're allowed to draw out of them. It was basically pension freedoms was what they called it, which now allows you to take any amount that you like out of your pension scheme in the UK. Although if you're a UK resident, there would be quite big tax consequences on that if you were to do it and you had a particularly large fund. What they did do when they brought that in, they extended that flexibility to QROPS in certain countries, and that included Australia. So when you're over in Australia, you would be able to draw from your scheme over there any amounts that you like. And as Paul said earlier, they're tax-free there if you've transferred your fund there. So you actually have a lot of flexibility, and actually the QROPS rules don't really impact you that much when you're in Australia, you've made the transfer over there. Now, they also introduced this pension age test, which was to look at countries and what happened to funds earlier than age 55, which is the earliest you're allowed to draw on pension benefits in the UK unless you're in serious ill health. Now, in Australia, there are some circumstances where you can draw funds out earlier in other circumstances. And so we had this situation back in 2015 where all the QROPS in Australia were removed from the list. We couldn't actually make a transfer to Australia for a little while. It's now possible, but you do have to be age 55 to do it, which is why Paul was taking you through the differences between pre and post age 55 earlier and the options that you've got there. Now, in 2017, they then revised the QROPS rules again. And at that point, they said that if you don't transfer your pension to your country of residence, then you would incur an overseas transfer charge of 25% of your fund. Now, that's not a problem if you go into Australia and you're transferring to an Australian scheme. The other exception is if you were transferring your funds to a QROPS in the EEA, and you were resident in another country, like for example, you lived in France and you transferred your funds to a Maltese QROPS. But Australia, despite now being part of the Eurovision Song Contest, wasn't a member of the EEA when I last looked. But as I said, if you're moving to Australia and transferring your funds to an Australian QROPS, you will be fine. Now, one other thing that we've put on here on the 1st of July 2017, 1st of July being the start of the Australian tax year. Although it's not relevant to the QROPS legislation, we've put it in here because it just shows that we also have to consider that Australian legislation can change sometimes. And Paul mentioned earlier that there is what's called a non-concessional contribution cap in Australia. That's the amount that you're actually allowed to transfer in 1 year from a UK scheme over into to contribute to a superannuation scheme in Australia. Now that's now $100,000 a year. You can roll up a couple of years and make a big contribution, but this needs careful planning, particularly if you've got a big fund and trying to work out how we can most efficiently get that over there. Now, when I started advising people on moving to Australia 11 years ago, that limit was 180,000. So it then reduced to 150, and then from 2017, it's been 100,000. And that's made quite a big impact, obviously, on those people that do have larger funds. And obviously, any further legislation changes will also have impacts on what we can and can't do as far as that's concerned. So it's just shows that we have to consider the changes that the UK government might make to legislation, but also the Australians might make. But this is what we do, and we're usually on top of these things, and we can find a way around them. So yeah, moving on to the next slide. The main benefits of a CUROPS, as I said, it allows you to be able to transfer your pension relatively easily to your country of residence. You can have your funds denominated in Australian dollars, although if you're not quite ready to make the change into Australian dollars because you're not happy with the exchange rate, for example, when you make the transfer, there will be options to hold it in sterling for a while within an Australian scheme if we do it the right way. It says here 100% of your pension passes to your dependent if you pass away. Now, if you're in a personal pension scheme in the UK, that's also true from a personal pension, that 100% can go to your beneficiaries. However, once you reach age 75, that's not necessarily going to be the case. In Australia, it doesn't matter what age you are when you pass away, your benefits will go 100% to your beneficiaries. So that can be seen as an advantage even over a personal pension in the UK. Paul mentioned earlier about the tax treatment benefits. You can draw tax-free from an Australian scheme, whereas if you're drawing on the UK scheme as an Australian resident, the Australian authorities are going to want you to pay tax on that. And also, it just, if you've already got, if you've spent some time in Australia already, you've got a superannuation fund over there, you transfer your UK funds there, you could potentially consolidate those two into the one fund over there. Although again, you would need advice on that because of the CUROPS rules and ensuring that you're not scuppering any of your plans as a result of doing that. So yeah, there's some clear benefits to it, but it just needs to be carefully considered. Now moving on to the transfer process. So this is really how you work with us. If we're looking to help you with your pension planning. So you contact start with, you request that we contact you and have a chat with you. That's no obligation. We'll just have a chat about your circumstances, briefly outline some options and just give you a bit more information than we've been able to do on the webinar today that is more relevant to your situation. It's information. At that stage, it's not advice. If you do want us to actually advise you in your situation, go off and get information from your pension providers, do more sort of fact finding, etc. with yourself, and then come up with a recommendation, then you can ask us to do that. We will then produce a report for you. We will then take you through that report and make sure that you understand everything in there, and we will agree a plan of action going forward from there. And you can then ask us to implement that plan, which might be a combination of, first of all, doing that consolidation in the UK using that SIP that Paul was talking about earlier, and then making the transfer over to Australia, considering those limits on how much you can transfer and the rules that are associated with it. And by having us on board over time, you'll also have somebody that's on the board as far as any legislation changes that might affect you, and we can help you to navigate your way through that. Okay, so in terms of why you should seek advice before you make any decision, well, as I said, there's changes to legislation all the time. The legislation itself is quite complex. Pensions tends to be the area that is very complex, and we're considering legislation 2 countries here. It's also, when you've been contributing towards a pension in the UK, a lot of the time, it's been a case that the money's come out of your salary, you know that it's being invested somewhere, but you don't necessarily really need to understand how it all works until you start to do something like move to the other side of the world. And that kind of means that you have to start thinking about that sort of thing, and we can help you with that. Now, worst case scenario, if you were to try and do all of this yourself and you get it wrong, there could be a penalty of 55% of your fund that goes to HMRC in tax. So it is essential to ensure that you do the right thing with your pension and don't lose more than half of it by getting it wrong. Particularly if you've got a defined benefit scheme, it's very, we need to be very careful to ensure that the transfer to Australia and changing the type of benefits that you have is actually going to be in your best interests, and we will help you to confirm that that is a good idea, or that you're better leaving it where it is, in which case you know that that's in your best interest for the future. That's fine, Steve.
Okay, so having listened to all that and run through the slides, why would you use BDH Sterling? Well, we have dual license advisors. That means we've got advisors here authorised and regulated by the Financial Conduct Authority, and our offices in Australia are also appropriately regulated in Australia to provide advice. We are defined benefit pension scheme transfer specialists, which means that we have the qualifications, the experience and the authorization to advise someone with a defined benefit final salary pension. And it's very important that you're getting advice that's provided all under the one roof. So you can be assured that when you start the process with us here in the UK, that's followed on through to our advisors in Australia, who can continue with your ongoing planning, not just for the pension transfer, but the whole of your holistic financial planning moving forward. We're able to provide advice to set up an Australian super through our Australian offices. We can provide tax advice, joined up tax advice from both sides, both in Australia and in the UK through our sister company BDH Tax. And it's important to have that retirement planning from start to finish, from the transfer to the setting up of the schemes to kind of the investing, to the point where you're looking to take retirement benefits, just to make sure there's that joined up thinking from the moment you join us here in the UK to when you move across to Australia. If you'd like to chat to a financial advisor, well, on the page there, there's how you can get in touch with us. Also, I think at the end of this presentation, you'll be provided with a phone number, and all the details are on our website. And I think the next section
time, is it?
I think that's it. I think the next section is the question and answers now.
Yep.
Okay, well, I'll kick that off. Somebody's asked whether the teacher's pension is transferable to Australia. Well, if you're still a member of it at the moment, well, the simple answer is no, you can't transfer the whole lot. You can't go and apply to the teacher's pension scheme to get a transfer value and then transfer the whole lot out to Australia. You will have to draw from the teacher's pension scheme in retirement and have it paid usually into a UK bank account, and then use a currency broker to try and time your currency transaction into Australian dollars. It will be subject to tax in Australia. Whether you'll pay tax will be determined by how much much taxable income you've got at that point. As I said, superannuation funds pay out tax-free, so it's just any other things that you've got that are taxable. But in due course, you might have the state pension from the UK kicking in that might use up some of your tax allowance in Australia. But yes, you can't transfer out the teachers. As I said earlier, just to reiterate, it's the teachers, NHS, police, civil service, armed forces and firefighters schemes that you can't transfer their class unfunded public sector schemes. They don't have an actual pot set aside for this sort of thing. You pay your contributions, etc., but it just essentially goes into the general government coffers, and they can then determine each year, they've got a good idea of how much they're going to be paying out in benefits, etc. But they don't allow a transfer out. Well, since 2015, they haven't allowed to transfer out of there.
Well, what about a university lecturers or tertiary education institutional pension schemes? What's the status of those?
Yeah, so if it's the actual university's superannuation fund, I believe that's what it's called, superannuation scheme, then that's fine. That is transferable. Yeah, we've transferred people from that scheme on a number of occasions before. As I said, it needs to be taken on an individual basis as well as whether or not that's in your best interest. It will be determined by your objectives and your overall situation and the transfer value that they offer you. But you can transfer the university scheme, but not the one that's actually called Teachers Pension Scheme. You can't move that one.
I'm just
so another question here is, if you move your pension to Australia, can you put it into another fund when it is transferred? Well,
do you want me to take that, or?
Yeah, you can. Yeah.
So this goes back to Paul's slides with regards to transferring your UK funds to Australia. There are, the fund that actually receives the UK pension scheme has to be a qualifying recognised overseas pension scheme, and the reason, the brief reason behind that is because the UK fund would have built up with tax relief and receive like generous tax benefits from the UK government, so they don't really want people to put their funds into a scheme in Australia or anywhere else in the world for that matter, where they can maybe use it for anything other than retirement planning. So what you can do, of course, is move it to an Australian scheme, typically a self-managed super fund. There are one or two retail schemes that are available, but once it's there, you couldn't immediately transfer or roll over into your own super fund or your employer super fund if it's not a qualifying recognised overseas pension scheme. You couldn't do that straight away. There are strict rules that the QROP scheme has to abide by for the first 5 years it's transferred over, and up to 10 years of the members' non-UK residency before the funds can be moved over to a different type of scheme that isn't a QROPS fund. That's not to say actually that's not to say you can't access it when you're retired and age 60, but as far as just like moving it across and then moving it to another scheme, you wouldn't be able to do that.
Yeah. And somebody's asked, is defined contribution transfer more straightforward than a defined benefit transfer? Well, essentially, yes. It doesn't cover. There's not the same considerations necessarily in terms of whether or not the benefits are going to be greater for you if you're already in an invested scheme and you're transferring to an invested scheme in Australia. But the Australian scheme will give you tax-free benefits and the UK one would be taxable. Well, unless there's anything like a transfer penalty built into the UK one, or some guaranteed annuity rates or some guaranteed growth rates, etc., then it may well be that it's much more likely that a transfer is going to be suitable for you than a defined benefit scheme. But once we've actually gone through the process of establishing that and then transferred out of those schemes into an interim scheme in the UK to prepare for that transfer forward to Australia, from there, there's no difference between the two. It's just really in that initial investment piece, and it can take quite a bit longer sometimes for funds to actually be transferred from a defined benefit scheme as that first step. So yes, defined contribution is essentially more straightforward than defined benefit transfer, but it still needs to be considered very carefully before you make the decisions as to what you need to do.
Pauls, you've talked about transferring your money at 55. Are there any other age considerations in terms of transferring if you're a lot older or the like?
Yes, basically the Australian schemes also have rules, upper age limits in terms of how much, when you can transfer and how much you can transfer. So I mentioned earlier that it's $100,000 a year you can transfer at the moment. Now you can roll up 2 years to make a $300,000 contribution. So you can do that right up until age 65. You can make the 300,000, but you wouldn't then be able to make a transfer in the following tax year or the tax year after that. It just gives you the opportunity. So if you, for example, had a fund of £150,000, you could get it all over there in one go, assuming the exchange rate was still below $2 as it is at the moment. But once you reach age 65, as it is at the moment, you can't do that rolling up anymore. You can only do the 100,000 each year. Now that is set to be changed to 67 before too long. COVID delayed a piece of legislation. We are expecting it to go through to 67 soon. And actually that 100,000, we are expecting it to go up to 110,000 in July as well. So yes, there's that consideration. But then once you get to age 67, if you want to make a transfer in any tax year after that, then you have to satisfy what's called a work test in Australia. And you have to demonstrate that you've done 40 hours work in a 30-day period during the tax year in which you're making the transfer. So for those that are fully retired, essentially once you get to age 67, you can't make any further transfers. Now, if you still have funds left in the UK at that point, because we haven't been able to get them all over there if you've got a particularly large fund, we've got other options that we can employ that are still very tax efficient for those funds at that point. But you know, that's a needs must, if you like. Now, even if you do satisfy the works test, once you get to age 75, you can't make any further contributions towards the superannuation fund in Australia. So yeah, there are various different things to consider as far as age is concerned and the intention to work as well.
It doesn't seem like we have any more questions from the floor. I'll just ask one more and then perhaps we'll wrap it up. My question would be, okay, so I've transferred my pension to superannuation and for whatever reason, I've now decided I've got to come back to the UK. What are my options?
So again, that's a very good question. So it's very important that you I think the first thing is very important that you just got to take advice before you transfer over. Again, not to kind of labour the point, but if someone's got a defined benefit pension scheme and they're looking to move to Australia, it has to be strong consideration about, yeah, that is going to be a permanent move. So given that everything's correct, you've moved everything to Australia, if you do move back to the UK, you can't actually transfer or roll over from an Australian superannuation scheme into a UK personal pension. So you can't actually transfer it back. So at that point, you come back, you become a UK resident, you'll have your Australian super retained in Australia. and there's some considerations then to think about. So first of all, you can at your preservation age, age 60, you can start withdrawing your benefits from Australia whilst resident in the UK. You need to take kind of tax advice on that, because you be deemed in receipt of foreign pension from the UK. You might be able to access it as a lump sum. Again, if you know you're coming back, there might be a possibility to do that before you come back. Again, that's something I would strongly recommend you take advice before acting upon. And if you move back to the UK and you're not at preservation age, then it's important that you have an advisor. And as I say, BDH Sterling have our advisors on the ground in Australia looking after your fund and managing your fund in Australia until you're at an age where you can start taking the benefits. And again, as I said, when you reach that point, it's important that you take the appropriate advice. So what I would say is, if you think you are going to come back, speak to your advisor about that before you go. If you think that, if you think that they're because that could put a different stamp on the advice. If you're going there with every intention to stay, which most returning Australians are do, and obviously UK people from the UK who moved to Australia, that they want to live out their life and retirement there as well. But sometimes the best laid plans. Speak to your BDH advisor in your local Australian office as to what to do, and if you know you're coming back, that there's no really it's not too early to go to an advisor and say, this is what I'm thinking about doing. What do I need to consider? Because it's a very important advice piece.
I think there's one more question that's come in there, Paul.
Yeah, so are there any tax implications if you transfer more after the first 300,000? I had read that perhaps there may be tax due if you transfer after you're resident in Australia for more than 6 months. Well, this 6 months rule gets touted quite a lot, and it is a consideration, and it's not. So when you make a transfer to Australia, if you make the transfer within the first 6 months, as long as you're within those limits, you will not incur any tax on that transfer. If you transfer after 6 months, then you will incur tax, but only on any gain on your pension fund between when you arrived in Australia, what the value was on that day, and the day that you actually make the transfer. And you will only get taxed on that growth at 15% if you pay it through the pension fund in Australia. Now, pension funds in Australia, before you start actually drawing on the benefits, while they're still in that growth stage, the accumulation stage, they are taxed at 15% on the growth as they go along anyway. So from that point of view, the 6 month, when sometimes you might find that certain institutions might be really pushing that 6 month rule as a reason why you've got to rush your transfer over to Australia, it's actually a little bit of a red herring, because you're potentially not saving that much tax, really, in that once it gets over there, it's going to get taxed as it goes along anyway. The idea of that tax on the growth when you transfer over there is really to ensure that you haven't benefited from leaving your funds in the UK in a tax-free environment for years, and therefore that you're better off than an Australian resident would have been if they've got taxable growth within their fund over there. So, it is a consideration in that first 6 months, and we do try to get transfers done within that time. If there's likely to be some growth that we can get over there tax free. But as far as future transfers are concerned, as I said, it's only going to be a growth element that gets taxed in between transfers. It's not going to be what you had in the first place. That all comes under this non-concessional contribution, and goes in tax-free. So, it is a consideration, but not a massive consideration. And certainly, if you were looking to rush your transfer over there within the first 6 months in order to avoid that tax, but you weren't entirely sure you were going to stay in Australia, then you've got all the problems that Paul was just saying about, if you've made the transfer, you come back to the UK and your funds are stuck out in Australia, and you then have potential issues with currency if you changed into Australian dollars, for example, currency risk in return, things like that. So really, it does need some careful consideration around all of these taxes, all of these limits, the legislation, everything. But this is what we do day in, day out, and if we're helping to guide you through that, then we know how to navigate that sort of minefield of various different things that we need to consider, and how to ensure that they apply to your situation in the most appropriate way.
Okay, thanks, Paul. Well, I don't see any other questions, folks, so I think we'll wrap that up. As you see on the screen there's an email, inquiries@BDH Sterling, if you want to contact us and ask to speak to somebody. So feel free to do that. Just add a little bit of information to give us some guidance. You will receive a copy of the webinar. That'll take a couple of days to be sent out to you. We just edit the top of the tail of it, etc. But within the next three or so working days, that should be there for you to have another look if you want to revisit it, because there's a lot in there in some occasions. So anyway, thank you for your participation, and we hope you'll contact us if you need help. Take care. Good evening.
Yeah, thank you.